Okay, so my name is Mensa Isaac, and today we are going to solve a question on accounting for depreciation. So with this question we have here, it says an extract from the statement of financial position of Fairman Limited as at 31st December 2020 is given below. We have the assets, the cost, and the net book value. The asset here is plant and machinery. The additional information is it is the policy of the business to provide for depreciation at the rate of 10% per annum on reducing balance basis. Good. Annual depreciation is calculated on assets in use at the end of the year and no depreciation in the year of disposal. The following transactions took place in 2021. Plant which cost 35 million and had been used for 4 years was sold for 24 million. Good. A new plant costing 40 million was acquired on 1st January 2021. You are required to prepare the plant and machinery account, provision for depreciation account for the year ended 31st December 2021. But you remember that the asset we have there was 31st December 2020, so we'll bring that asset what? Forward. Okay, they are also requiring us to calculate for our plant and machinery disposal account. Good. So with this, we are going to start with our workings. Good. And for our workings, we know that they said an asset which cost what? 35,000 had been used for what? 4 good years. So that means that from the first year the asset was bought, it accumulated or it was charged a depreciation. The second year was charged a depreciation. The third year was charged a depreciation. The fourth year it was sold. Do you get it? And the question said there was no what? We shouldn't charge depreciation in the year of disposal. That means the fourth year we are not going to charge a depreciation. Do you get it? Good. So let's say you don't know year 1, year 2, year 3, and year 4. Okay. And the asset here was plant and machinery, right? Plant and machinery. Good. So we are using what? Reducing balance basis. Good. So for this, what we are going to do is for year 1, as I said, we are going to calculate on the cost for year 1. The next year we are going to calculate on the net book value. The next year net book value. Do you get it? So we have the cost of that asset to be 35,000 times what? They said we should use 10%. Good. So 10%. And we are getting what? 3,500. When we come to year 2, we are going to what? Calculate on the net book value. So the cost here, 35,000 minus our depreciation, 3,500 times our 10%. Good. So for this 35,000 minus 3,500, we are getting a net book value of 31,500. So that's 31,500 times our 10%, and we are getting on 3,150 for year 2. Good. So for year 3, when we come to year 3, we have a new what? Cost. Okay, the net book value is our new cost. So in year 3, we are using reducing balance, so 31,500 minus our 3,150 times our rate, 10%. Okay, so when we come here, when we subtract 31,500 and we subtract the 3,150 from 31,500, we are getting 28,350. times our 10%, and we are getting 2,835. Good. And that's for year 3. This asset was used for what? 4 good years. But they said we shouldn't charge depreciation on the year of what? Disposal. Good. We also have an asset here, a new plant costing 40 million. Okay, 40 million was acquired on 1st January 2020. So that means that this year is our what? 2021, right? So a new plant was acquired on 2021. So this year is our 2021. We are calculating or preparing our books to 2021. So technically, here is 2021, here is 2022, here is 2020. Sorry, here is 2020, here is 2019, here is 2018. So that means that this asset now as a 35,000 was bought during 2018. Then we use it for 4 good years. Okay, but the question said for the last year or the year of disposal, we shouldn't what? Charge depreciation. Good. When we come to the I-6, a new plant costing 40,000 was acquired on what? 1st January 2021. Good. So that means that this year we will have an asset. We didn't have that asset as at 2020, as at 2019, as at 2018, but we had that asset, or we bought that asset as at 2021. So the 40,000 here times our 10%, what are we getting? 4,000. Do you get it? Yes. The question is given to us in millions, so let's introduce our zeros here to make things simple for us. Good. You see, so for 2021, we had a depreciation. It's reducing balance because we are not to calculate for 2020. We are not going to calculate any rate on the net book value for the subsequent year. Okay, because we are ending just in 2021. The books, we are preparing the books up to 2021, ending 31st December. So our depreciation, our rate will be on the cost, and that's it. Okay, so for 2021, we have a depreciation of this amount. Good. But when you come to the question, so let's add this total. When we add the total of these, the depreciation of these, we are going to get 9,485 for the total depreciation. Okay, so that means that this is the total depreciation for the assets used for 4 years. Do you get it? Good. When we want to find the actual net book value for what? 2021. Okay, for 2021, how do we get the net book value for this 35,000? The accumulated depreciations. These are the depreciations for each year. Okay, so now we want to find our what? Net book value, our original net book value as at 2021 for that 35,000. Okay, so what we are going to do is the 35,000, sorry, this 35,000 minus, so cost minus accumulated depreciation for that asset, we are getting 25,515. Do you get it? So this is our what? Net book value for this asset. Do you get it? So over the years, this asset accumulated, so this asset, the 35,000 accumulated a depreciation of what? 9,485. So if you want to get the net book value of this asset as at 2021, you are going to subtract the accumulated depreciation from the cost of the asset. Do you get it? And we are getting a net book value of 25,515. Good. And from the question, you will see that there is a net book value in the question. Okay, that plant and machinery 200,000 there, okay, had its own depreciation, and after depreciation the net book value of that 200,000 was 125,583. Do you get it? So that means that if you want to find this depreciation, or if you want to find the depreciation of this asset, we are going to what? Less the 125,583 from 200,000. So 200,000 minus 125,583 is going to give us our depreciation for that asset. You get it? And we are going to get 74,417 for that asset in the question. You get it? So that's the depreciation of that asset in the question. Good. As at the year ending 31st December, these were the balances brought forward. That means that this 35,000 was included in the 200,000. Do you get it? That 35,000 was included because we are bringing that amount, which is 200,000, from 2020 to 2021. So that amount you see there, the cost and the net book value, is starting the year 2021. Do you get it? So that means that if we bought this asset at 2018, during 2018, then that means that this cost of asset is in our what? Balance brought forward for the plant and machinery. Do you get it? Yes. So when we come here, if you want to know the actual cost or net book value we have now, we are going to what? Subtract our 35,000 from that 125. What net book value did we get for? We had 25,515 as a net book value for the 35,000. Good. And our net book value brought forward was 125,583. Good. So that means that, you see, actually they didn't tell us that the 35,000 was brought forward to 2021, but we could see that if these were the balances brought forward for plant and machinery, and you are telling us that we bought this asset and we used it for 4 years, that means that this asset was already there, so it is included in the balances brought forward for plant and machinery. Do you get it? So if we sold that asset during 2021, and we want to know the actual net book value for plant and machinery we have now, what are we going to do? We are going to subtract this amount from this amount. Okay, this amount is there. This amount is included because it's part of the plant and machinery we brought forward to 2021. Now we sold this amount. This net book value has been sold. So what do? We subtract our 25,515 from it. Okay, and we are going to get, when we subtract 125,583 minus 25,515, we are going to get 168. We are going to get 168. Yes. Good. So this is the actual net book value we have as at the year ending 2021, because during the year we sold what? This net book value. Okay, how did we get this net book value? Our original cost 35,000 minus its accumulated depreciation, we got a net book value of 25,515. Now the question said we sold it. Okay, we sold it, but as at 31st December 2020, this was the net book value that we were having. That means the cost or the net book value is included in this net book value. Do you get it? So since we are selling it, we are going to what? Subtract this from this. Do you get it? And first of all, the question told us that no depreciation is charged on what? That asset the year we are selling. Do you get it? So if you want to calculate our depreciation here for our new net book value that we have. Okay, because for every year, because we are using reducing balance, we are going to charge depreciation on what? The net book value. Reducing balance, for first year you are going to charge on the cost, second you are going to charge on net book value, subsequently net book value. Do you get it? So if we are in the new year, that's 2021, we brought forward, and as at that year our cost was 200,000 for that balances brought forward from plant and machinery. But after the year ending, we had a new cost of 125,583. Good. So this one is what our new cost now. Good. So we will also find our new cost for what? The 35,000 plant and machinery. So we will subtract our depreciation from the 35,000, then we'll get our new book value for also that plant and machinery. Do you get it? Then we'll subtract from this, because no depreciation is to be charged on this for the year of disposal. Do you get it? So in order not to make any mistake, we want to calculate our new depreciation for 2021. You said no depreciation is charged. So now we are going to what? Less our net book value, the sold net book value or the cost of that plant and machinery from this balances we have now. So that means that there are other assets that we also bought. But for the 35,000 assets, which is having a new net book value of 25,515, we sold it and we said we shouldn't charge depreciation. So we are going to less it from the plant and machinery that we have starting the year. You get it? For those, we are going to charge depreciation because we are not selling them as at that year. You get it? So when we subtract, we are going to get this. So for our new depreciation as at that year, what we are going to get is what? We are going to multiply this new net book value we have, because we subtracted the amount to, so that we will not include, because this is in this net book value already, so we want to subtract that amount from it so that we will not charge a depreciation on it. We get it for that year. So we are going to subtract it from this. What we are getting is this. Then we will multiply it as usual by the 10% that the question has given to us. So when we multiply it by 10%, we are getting 10,006.80. Do you get it? 10,006.80. Good. So that means that for that year, we are having what? 10,006 for our what? Depreciation. Good. And the question says a new plant costing 40,000 was acquired for 40 was acquired on 1st January. A new plant. That means that it was not included as at the balances brought forward. It was not included in the balances brought forward. So that means that we only bought that asset on 1st January. But for the 35, it was included in the balances brought forward. Do you get it? Good. So for the 40,000, we will calculate our depreciation for that one. So now if you want to know the depreciation as at that year, what are we going to do? We are going to add this to this amount. Do you get it? We are going to add this to this amount. So because this is a new depreciation, right? This is a new depreciation. It's a new plant and machinery we bought for that year. But this amount was included in the net book value. You get it? So we subtracted, in order not to calculate depreciation on it, we subtracted from our net book value brought forwards. Then we had this amount. That means that this amount is what we are supposed to charge depreciation on, because the question said for the year of disposal, no depreciation is to be charged. And as at that year, the net book value of that asset was 25,500, and we don't have to charge depreciation on that. So we subtract it from this, then we'll get this one to be our net book value, for which we are going to charge what? Our depreciation on it. And we are going to get this for the rest of the balances brought forward. You get it? And a new plant was also acquired or purchased. We are going to calculate that depreciation for that. Good. So when we want to find the yearly depreciation for 2021, it's going to be 4,000 plus 10,006.80. Do you get it? Good. So we are going to get 14,006.80 for our what? Total depreciation for the year. Good. So this is what, when we go to the provision for depreciation, we are going to what? Credit. Good. This is what we are going to credit in the provision for depreciation, as we already said in our first video under accounting for depreciation. So the amount we are going to debit in the provision for depreciation is the total accumulation or the total accumulated depreciation for the asset sold. Which asset was sold here in the question? It was the 35,000. What depreciation did the asset accumulate? This was the depreciation the asset accumulated. So we are going to debit the provision for depreciation with this amount. You get it? And the yearly depreciation was this amount. So we are going to credit. And we already had a depreciation. You get it? In the question, balances brought forward. The old amount cost was 200 and now 200,000 and now it is 125,000. We are going to subtract from it. We are going to get 74,517, and it will be also at the credit side, showing that that year that was the depreciation also left. Good. The depreciation was forward. Sorry. So we are done with our workings. We are going straight to open our account. Good. So we'll go to the machine account. So with machine account, we know that the cost of the asset we bought will be debited. The cost of the asset we bought will be debited. Good. So we have plant and machinery. Plant and machinery. Good. So with this plant and machinery, we know that we already have a cost there in the question, and the cost brought forward was 200,000. So we have a balance BD of 200,000. Good. We also have another asset that was bought. Do you get it? We are only recording our cost amount. We have another asset that was bought, which is 40,000, right? We have our Ghana cedis here, with the 3 zeros to make it very simple for us. So we have 40,000. Technically, it's 40 million, right? But we have zeros on top, so we just say 40,000. Good. Then we also disposed an asset, right? So in this asset account or this plant and machinery account, as I've already said, the asset or the cost of the asset disposed is what you are going to record, okay? Not how much you sold it for. So the cost of the asset we sold was 35,000. That was the actual cost, the original cost we bought the item, and it was sold. So we are going to record that actual cost here, disposal, which is what? 35,000. Do you get it? Good. Now there is no asset we bought again. We've recorded our assets we bought or we had. The balance brought down after 2021. We had 200 assets, 1,000 assets at our disposal. We bought 40,000 again. So we also sold, as at 2021, we sold a cost of an asset which was 35,000. The cost of the asset we sold was 35,000. So now we will find our difference, and the total, we know that here will be bigger than this side, so our balance CD will come here, and the total here is 240,000. 240,000. Good. And we have our balance CD here, and the difference is going to give us 205,000. Good. So that's it for our, so this is 2021. So when we are bringing it forward, it becomes 2022. So the balance CD we are having is going to be balance BD here. We are having 2,000 and 205,000. Good. So that's all for the plant and machinery account. Good. So we move on to provision for depreciation. Provision for depreciation. So with the provision for depreciation, as I've already said, our yearly depreciation is going to the credit side. Provision for depreciation. Our yearly depreciation is coming towards the credit side. And we already calculated for the new plant and machinery bought, and it was 4,000. That was the new depreciation. And we already had or calculated for that year's depreciation. Okay, we also calculated for that year's depreciation, and we had 10,006.8. Good. So when we added the 4,000 and 10,006.8, we got 14,000. Good. So here we are going to record depreciation. So our depreciation here is going to be sorry, we already have a balance BD. So we will first work for our balance BD for provision. How do we get our balance BD? We know that in the question, the 200,000 had a net book value of 125,583. So to get our provision, the new cost was 125,583. So how do we get our depreciation? As at the year starting 2020, the cost of our asset was what? 200,000. As at that year ending 2020, the cost or our new cost was what? 125,583. So that means that it has what? Depreciated. Good. So how are we going to get our depreciation? That 200,000 minus our 125,583, and we are getting 74,417. So when we come here, our date is here, our Ghana cedis, balance BD, okay, here, our depreciation brought forward was 74,417. Good. So this was the balance brought forward for provision for depreciation. Do you get it? And as I already said in my previous video, this provision for depreciation is what we send to the balance sheet. Do you get it? Because the balance sheet deals with accumulated depreciation, but for the depreciation account, it deals with, we are sending to the P&L. So every year we close it and send it there every year. So there's no balances carried down and brought forward. But with this, we had a previous depreciation, so we have to bring it forward. Then what's our new depreciation for that year? That is what we've already calculated. Do you get it? And we had that depreciation to be 14,006.8. So we have depreciation 14,006.8. Good. So this was our depreciation. Good. So now we move on to the debit side because we are done with this side. Our yearly depreciation is there. Our balance brought forward for depreciation is there. Good. Then we come to this side. And we know that for this side, we are going to record if there was any asset sold. What was the asset depreciation? Asset the year it was sold. Good. So when we come here, we had 9,485 for the depreciation, okay, of the asset sold, the total depreciation of the asset sold. So when we come here, disposal, and we are going to write 9,000 485. Do you get it? Good. We are done because here we record the yearly depreciation and here we record the what? The total depreciation of the assets sold. Good. So with this, we know that this side will be greater than this. So we have our total to be 88,423.80. 88,423.80. Then when we find our difference, we are going to get our difference is going to be 79,938.80. Do you get it? Good. So it's just we just have to bring the balance here. Balance BD is what? 79,938.80. You see, so if we are to calculate for 2020, the depreciation for 2020 here, we'll come and put that one to here. Okay, so the depreciation for last year is coming. Okay, so if there was any other depreciation for 2020, if you have to calculate for 2020 and we had a depreciation for 2020, that yearly depreciation will also come here. That's how it is. So we are done with the provision for depreciation. Now we are moving on to our disposal, our plant and machinery disposal. Good. So with the disposal, we know that the provision or the accumulated depreciation of the asset sold will come here. Then the amount we sold the asset will come here. Then the cost we sold the asset will come here. Good. So we have our Ghana cedis. We have our year. We have our Ghana cedis. We have our year. Good. So with this, they said the assets we bought for, let's go back to the question. It says the assets which cost 35,000 had been used for 4 years was sold for 24,000. Good. We are not doing asset account, or we are not recording asset account. Good. So what we are going to do is we are going to record the actual amount of the asset that was sold. Good. So when we come here, what we record here is the cash. It was sold for what? 24,000. Good. Then we have our provision for depreciation. Our provision for depreciation here was our depreciation here. Sorry, this is disposal account. Disposal, not provision for depreciation. So our disposal account. So the actual amount we sold the assets is here. Then we will less the provision or the total depreciation of the assets sold as at that year. So provision for depreciation. We had the total depreciation of that asset to be 9,485. We have our zeros here. 9,485. Good. Then we have cash. We've already written our cash because it was sold for 24,000. Good. Then we sold which assets? The 35,000. And as I said, the 35,000, the cost of the asset, the original cost of that asset we sold is going to be here. So when we come to the debit side, we are just going to write plant and machinery, because it was the plant and machinery we sold, and the cost of the assets we sold was what? The original cost was 35,000. Do you get it? Yes. So that's all for our disposal. So when we come here, we'll just come and see which side is the greatest, and we know that this one is bigger than what? This one. So we are going to have that amount as a total for both sides. Good. We have 35,000. Then we know that we will send this to P and L. And the P and L, the difference is going to be P and L. And the difference we are having is 1,515. Do you get it? Yes. So that's all for this question. So first of all, this question requires us to open our plant and machinery account, provision for depreciation for plant and machinery, then our disposal account, our plant and machinery disposal account. So as I said, the plant and machinery, the debit side will be the asset, the original cost of the assets you bought at the debit side. Then if you sold any of the assets, you record the same original assets, the original cost of the assets at the credit side, not the amount you sold the assets for. You get it? Then when it comes to provision for depreciation, because it's a provision for depreciation, we know that we are accumulating our depreciation. We will bring our balances forward if there's any. Then we will also bring our yearly depreciation. Do you get it? Good. For this question, there was balance brought forward as at the year 2021. So we'll bring it. That was provision for depreciation. We brought it. Then we added our yearly depreciation. Then when we went to the credit side, the debit side, we had, that we are going to record the accumulated depreciation of the asset sold. Okay, so the accumulated depreciation of that asset sold was 9,485. Then we recorded it at the debit side. Good. When we come to the disposal account too, the actual amount you sold that original cost for, okay, is what you are going to write here. Good. Then you come here to write the accumulated depreciation of that amount. So it just has to be in your head. Good. So when you check the whole account or the whole draw up system too, you could see that it's following the double entry principle. We were required to open only 3 accounts. Okay, so we didn't show for cash. Good. Then now, plant and machinery, the debit side will be the actual cost, the original cost, what was the original cost of the asset you sold. They get it. That is what you are going to write here. And here is the actual amount you sold the item for. And here is the original cost, the asset you sold, its original cost. That's what you are going to write here at the debit side. So this is all for this question, and we will meet another time to solve questions on depreciation. My name is Mensa Isaac. Please subscribe, like, comment, and share this video. Thank you very much.